All right. Welcome back, guys. I'm your host, Chris Dunn. I'm here with Nikki in person and Travis through the
High
interwebs.
five.
Hey, this is the challenge with having like multiple homes and living in multiple places is you have to have multiple studios. So anyway, guys, after a month-long hiatus, we're back. What's up, Trav? How you doing over there?
Hey, I'm great. Thanks for asking.
Yeah, man, we've got a lot to cover today. So let's just get right into it. I wanted to start by talking about, since there seems to be so much bearishness out there, let's start by talking about what are our actual best performing assets in 2022 so far. Nick, do you want to kick us off and maybe give a shout out to our sponsor?
Yeah. Big shout out to Y Charts for sponsoring the show. As a retail investor myself, I use it for all my fundamental analysis. And my favorite thing is the stock screener. Crazy powerful and amazing. Go check them out. Go to ycharts.com. Tell them We Talk Money sent you, and you can get a free trial. Check it out for yourself.
Cool. So what's your best performing asset or stock or investment so far in 2022?
Funny. Well, can it be something I've bought years ago that's still doing really well?
Yeah, something that you've taken profit on or that you're still riding, or what is performing well this year? Because, stocks are down, Gotcha. Bitcoin's down. A lot of things are down, even though they're not down a ton right now. There's, a lot of things are just lackluster.
Yeah.
So if there's anything that's like sticking out, that's like an outlier profit, it's kind of interesting to look at those things when most things are either flat to down, right?
I have been surprised at the strength in my Apple stock. So Apple has been not too far off from all-time highs. It had a really strong, but I swear last week I was like, is this thing going to run for all-time highs? And it
got close.
I mean, the strength in relation to the indices and in relation to other stocks, especially growth stocks. And Apple is technically, on the cusp of growth stock, if not growth stock, depending on the quarter you're looking at. But I've just been really surprised. I've been taking cash out of it. I'm taking profit to get ready for trading opportunities, because there have been tons of trading opportunities that have been setting up in the market. So Apple and Twitter and I think either Ulta or Lululemon have kind of been my outlier performers.
So big tech and big yoga pants. Okay.
And big makeup.
Oh, there you go. Trav, what about you, buddy?
Well, the list is short in terms of assets that are really performing this year, but certainly the handful of energy stocks I've got in the portfolio, like Devon Energy, Ovintiv, and the AMLP ETF, all of which I bought, I think about 3 years ago. Those are all up nicely this year. So that's been a nice bright spot in the portfolio. And, I have a lot of other positions. Unfortunately, I'm not, I didn't YOLO into energy and get out of everything else like some people might have, but it's nice to have that balance there where you do have some assets that are performing well. And Nikki mentioned Twitter as well, which obviously had got a big boost and I think is up about almost 20% year to date. So nice to have a few of those as well in the portfolio, but it's been tough going overall. It's just been really tough, very choppy, and a very difficult environment for stocks so far this year.
It really has. And I've talked a lot about managed futures accounts and things that kind of do well during bear markets, right? And I think that's kind of the environment we're in, right? Like there's a lot of chop. There's been a lot of sideways action. We can obviously dive into the charts and talk about some TA and where we think things are headed. But for me, my best performing asset so far this year has been managed futures accounts. I'm up about a blended return somewhere around 35% year to date so far, which is nice because, again, when everything else is really volatile, and you have these managed funds that are trading for you, I used to be an active futures trader, and I was like, well, why don't I just take a step back from that active trading and give it to, guys that literally employ PhDs and mathematicians and let them do it for me. And I do not regret that decision, let's say.
Mm-hmm. Yeah, it's definitely nice to see a hedge fund actually hedging.
Yeah. And
Hedging a portfolio.
and I'll link this up for anybody. You know, I always get questions about, you know, well, how do I get in with a managed futures fund? What is that all about? I'll link this up in the description. It's rmcalternatives.com, and they have some infographics and some different things that they basically will show you, like the different types of funds and the different strategies that they have. So, you know, you have like high frequency, you have currency, you have trend following. And a lot of the funds that I like trade all of the futures markets. You know, if it's agricultural or stock indices or, you know, energy, they basically trade it all, and they're long, short. They're not biased in any direction. They just trade volatility. And when you're in bear markets or when you are in high periods of volatility and choppiness, when things are really not going anywhere, those funds do really, really well. So I just like to have that as a piece of the portfolio. And that's where I've actually made the biggest return so far this year.
What a great market for commodity traders.
Yeah.
They've been probably like waiting on the sidelines for a long time, just waiting for something exciting to happen. And then boom, it all just blows up. So I'm sure they're happy about that.
Yeah, it's been wild. Just taking a look at the charts too. I mean, crude, you know, oil, gas, natural gas, they've actually pulled back the past couple of weeks, along with lumber and other things. But it's funny, I actually bought some lumber yesterday and for a project I'm building, and prices are, even though the lumber futures are down, you know, they're at like what, 880 today, and they had a high around 13 or 1400. Prices are astronomically high in Lowe's and Home Depot and stuff. So I don't know.
They're marking it up, and you know, you're paying the premium.
Yeah. So, all right, let's talk about the second thing. Mortgage rates. This is probably the story of the week, is the fact that mortgage rates have gone above 5% for the first time since, I think, 2011. Is that right? Yeah, just crossed 5%. And if you take a look at the rate here, this is, I think, a kind of trailing, but you can see here on Y charts where we hit a low back in December of 2020 at about 2.6 or 2.75. And we're climbing above that 5% mark. So I don't know. What do you guys make of this? What are the implications? What's going to happen next? Nick, I know you had this tweet where you were showing, what is this?
So this is just showing the trend between the 30-year mortgage rate and the housing price index, which the housing price index is a collective of, you know, all 50 states, a bunch of different markets. And it's just showing the complete negative correlation between the two. And how what I think is interesting with this is we've been in this downtrend with mortgage rates for so long, and we've just seen housing prices soar with that downward trend. And if that mortgage interest rate trend breaks and we do see significantly higher 30-year mortgage rates, so a lot of people have argued that higher rates, you know, they may not affect housing prices, but I can't help but think that a significant shift in rates higher would definitely affect housing valuations. I don't see how it doesn't. The only thing that could maybe make it not affect valuations is the fact that supply is still so constrained in the housing market, and demand is probably still there. Maybe not, you know, to the same degree, and we are going to see consumers see higher mortgage payments. So maybe this prices some people out because it can affect a payment in terms of, you know, up to a couple $100 or more, depending on the rate. So that could shift some consumer behavior for sure in the real estate market, as people just can't afford the mortgage anymore. But I don't know. It's a tough environment because of that supply issue. I think that it makes it very difficult to predict.
Yeah, I agree. I mean, and taking a look here at the 10-year bond yield, this is the chart we've been paying a lot of attention to recently, is the fact that we're starting to challenge the upper end of this downtrend line, right? So rates have been coming down since the 80s. And after hitting a low back in, basically the COVID panic of 2020, rates are flirting with breaking out above that. And with inflation at, 7, 8, 9, whatever the actual number is or higher, it's not a surprise to see rates going up.
I think that a lot of people think that housing prices can't go down. They think housing prices are kind of like a sure thing. And it's funny, I've seen some hilarious comments on Twitter about this, like, who loses money in the real estate market? Housing prices don't go down, they go up all the time. And it's anybody that loses money in real estate's an idiot. And, that's been the way it has been recently. But I can't help but wonder if that's going to change, and buyers may end up, or, people that have real estate as their asset and don't think that prices can go down, and they're mortgaging their home to buy GME and AMC, things like that. Like, they think that this can't shift. And what do you guys think? Do you think housing prices can go down, or is it a sure thing and they're always going to go up?
I mean, I think we saw back from the great financial crisis that this myth that housing prices never go down, it's just not true, right? But there's interesting macro dynamics colliding here, because like you said, you've got the demand supply dynamics in housing over the past few years have really supported home prices, where we underbuilt houses after the great financial crisis. You have millennials coming into, the prime home buying years. You have, a lot of things shifting because of work from home. And so housing demand has exploded, while at the same time supply has been relatively constrained, especially in hot markets. So that's why we've seen such explosive home prices. We've seen, these stories about people 50 to 100 people deep going into the first day of open house at many houses. So that has not changed. Those factors don't change necessarily. What does change is obviously mortgage rates probably mean, just in the last couple of months, I think the change in affordability is somewhere between 10 and 20% on average.
It is
from the existing mortgage rate increase. So right there, you have a 10 to 20% headwind already. And if mortgage rates go higher, then that number could rise. So you have an impact straight away, a direct financial impact on affordability. And that there's no question that will have an effect on some buyers. I guess the real question is, how does that change the overall supply demand dynamic? Is it enough to wipe out enough demand that, that prices actually stay flat or go down? I think for certain areas that will happen. I think for the hottest areas, I doubt you see that big of a decline in home prices in the near term, unless mortgage rates go to, 8, 9% in the next year, in which case, I think certainly you will see the housing market correct. But yeah, it's a complicated equation, right? You've got the supply demand dynamics meeting, affordability issues with higher mortgage rates. So
yeah, the big difference between today's market and back in the early 2000s is the supply side of the equation, right? Like back then, builders were just building like crazy, and they were building on speculation. And, I was actually in the mortgage business during that time. And I remember, condo developers in Miami and, cookie cutter home builders in Tampa basically saying like, we are going to build as fast and as cheaply as we can. And we know if we build it, they'll come, right? Well, they built way too damn much. And that's what created that top. And like right now you've got prices going up, but you've also got a supply constraint, right? So that I agree with you guys. Like that creates this weird thing where it's like, well,
tricky.
Yeah. Like, well, obviously if rates go up, that's going to create some affordability squeeze, and most people overbuy what they can really afford anyway. So maybe at the lower end, this will affect, like affordable homes. And I was watching the other day, it was like in, what was it, Raleigh or so, one North Carolina city, there was like 0 homes under 300,000. And there was one that came up, and they showed like the open house or the first day of the listing, and it was just swarmed with hundreds of people. So, on the lower end, there's always going to be demand for those prices. And as that barrier gets pushed up, I don't know, maybe some people will give up and go back to renting if they can even afford that, because rents have been rising like crazy too. So
that's a really good point, that this is really going to squeeze the lower end buyer. And did you guys know that the average sales price of a new home right now is $511,000?
Yeah. Is that up from like 300 something?
Yeah, it's up a lot. Yeah. And then an existing home, it's like 370 or something like that. Like that's hefty.
Yeah.
That's a lot.
When you look at average
For
wages,
most
they haven't
people.
kept up with that. Yeah.
Yeah.
Well, we'll keep an eye on that. Okay. Kind of in line with that, there's this narrative coming back that we saw, what was it, 2020 or 2019, where we got a quick inversion in interest rates. And, there's that narrative is back on the table where we have a little bit of an inversion in rates, and people are really starting to worry about this. Let me see. I've got the yield curve right here. So you can take a look at, you can go back in history for you guys watching the video, and you can see what the yield curve looked like. I'll link this in the show notes as well. You can go back over, basically comparing the stock market to the yield curve over time. And you can see right now, we've got 5-year yields that are slightly higher than 10-year yields. And this historically has been a signal for a coming recession. I'm going to kick this to Travis, since you're the smartest guy in the room. What do you make of this, if anything?
Thanks. So the yield curve stuff has gotten a lot of play in the last couple of weeks, and basically yields have been rising across the curve. So all yields are up from the 2-year to the 30-year, but they're especially up at the front end because this expectation now that the Fed has been behind the curve. Now they've signaled they're going to aggressively raise rates. In fact, I think in the next 2 to 3 meetings, the market is now forecasting the Fed is going to raise rates by 50 basis points. So that's like 2 rate hikes essentially in one. And so that's, that's obviously something that they probably didn't want to have to do a year ago, but now they're being forced to because of the rate of inflation. And typically when you have rates that increase that fast, you're going to have a cooling economy, and that's going to create fears about recession. And this is no different. And one of the things that has often forecasted upcoming recessions is the inverted yield curve. So when you have rates on the long end, say the 10 or the 30-year, go below the rates on the front end, what the market is saying there is basically that we expect rates to go higher in the short run because of what the Fed is doing. But in the long run, we actually expect that the Fed is going to have to start lowering rates again because demand is going to cool and the economy is going to cool. And so that's what the bond market is essentially saying when the yield curve inverts. Now, not every single yield curve inversion, as you can see here, leads to a recession. Well, actually, this chart does show the yield curve inversions that did lead to recessions.
It's a pretty high probability situation, isn't it?
Yeah. So we see in the past that many recessions, in fact, most recessions are preceded by an inversion in the yield curve. Now, that doesn't mean that every single inversion in the yield curve does forecast a recession, if that makes sense. So pretty much all recessions, prior to the recession officially hitting, we do see inverted yield curves, but not every inverted yield curve does lead to a recession. So it is important to keep that in mind. But I kind of share the bond market's concern here because the Fed has been consistently behind the curve, and now the Fed continues to be aggressive and they want to cool financial conditions. We're already seeing GDP figures and manufacturing PMIs weaken. And so we're already seeing basically some indications in the economy that the economy is weakening. We already know that inflationary pressures in things like energy and food are going to continue to get passed through to the consumer in probably a more vicious way as we go through the year. Rents continue to rise as well, like you mentioned. So the inflationary pressures are not going away. And at the same time, you have the Fed really rapidly trying to catch up and cool things when, in fact, things are already cooling. So I'm very concerned, actually, that a recession could be here by the end of the year. And in fact, we also saw like Deutsche Bank come out this week and say that they expect a recession in 2023. So I think this is quickly becoming a narrative that a lot of market participants believe, including myself. And unfortunately, the Fed continues to be behind the curve. And frankly, they're probably going to be slow here on the backside as well. Just as they didn't raise rates quickly enough as inflation was starting to bite last year, they're probably going to end up raising too far, and they're going to actually be raising rates at a time when the economy probably has already cooled. Mm-hmm. So they're going to make things worse, just as they have over the past several years, unfortunately. Mm-hmm. And the reality is that's going to make it challenging for many asset classes and many different assets, I think, in the next year. Sorry to be Debbie Downer.
Well,
here.
that's the end of the show. All right, wrap it up. Our portfolios are going kaput.
Okay, I will say one other thing real quick. One other piece of good news here is that unemployment across most major developed economies continues to improve. So our starting point going into this is actually pretty healthy. We're not at a starting point like we saw before the great financial crisis. We do have very, very low unemployment across many countries. We do have relatively healthy consumer balance sheets in many places. So the starting point, at least, is a relatively healthy place. And we do have a significant number of job openings still unfulfilled. So even if the economy weakens somewhat, there's still probably some existing supply and demand constraints in the job market that may actually keep us from going to very high levels of unemployment in a recession. So I do expect if we do get a recession, hopefully it'll be relatively short and we won't see, 10+% unemployment. We'll maybe go from 3.5 to 4.5 or 5. That's my hope and my expectation now. And so I do want to say, like, I don't expect this to be like the end of times and we're going into a Great Depression.
It is interesting how the unemployment rate here in the US is back to pre-pandemic levels. Like it was like massive spike and then immediate reversal and almost back to normal with a ton of demand for workers. So yeah, that is the bull case, I guess.
Yeah, I think that kind of is the unique situation here is not only do we have unemployment rates so low, but also we still have not fully recovered from the pandemic in terms of like demand for traveling, demand for going out, events, doing things. I know a lot of people that don't care how much it costs. They're getting on that plane and they're taking that vacation this year or next year. So that kind of has been something I've thought about a little bit. Like, is the consumer to a point because of us coming out of this 2-year pandemic and them not being able to do things that if we do see the globe open up, more economies open up, that demand is so strong to get out there and do. And a lot of money is going to shift more towards services versus goods. But I still think that there could be something there to kind of helping the blow of a recession or helping the blow of decreasing growth.
That's a good question. And let's take a look at the charts, because earlier today I was like, man, this chart looks really bearish. And Nikki was like, what do you mean? This looks bullish.
What are you talking about?
So for anybody listening on the podcast, we're going to look at Bitcoin. We're going to look at the stock indices. We're going to look at some correlations here. But I always like to say, like, charts are truth. You can always see the narrative and the emotion in charts. And if we're looking at the NASDAQ 100, so basically if we're looking at big tech, you can see we had a really big sell-off in the first quarter of the year. We were basically down over 20% from all-time highs. And then we had a really strong bounce in March that brought us right back to the 100 period and the 200 period moving average. And as of today, which is March 6th, we broke yesterday's low and it looks like we're rolling over here. Now, obviously this little dip could get bought up at any moment in time. My question is, and this is where kind of bear markets develop, right? This is where they start, is on that first lower high. Like if you go back to 2008, you can see it. And even before then, once you start to put in those lower highs and start to pull back and challenge that, and the bearish pressure builds before the big panic, that's my question, is like, is that where we are? Or is this going to be a fake out like we had in 2020 and 2018, where it looked like we were going to put in a lower high and then it trapped and ripped to all-time highs? Do you guys have a prediction or a guess or any way you want to put that?
I personally, we had a pretty strong bounce. You make a great point about the price action and comparing it to 2008. And this could go either direction.
Yeah.
I think that the S&P looks stronger, obviously, than the NASDAQ because it's more diversified. It's got energy in it. It's got some things going for it. And growth has just been hammered.
Yeah. Here's the S&P, which looks pretty
better, similar, but better in terms of like moving averages and things like that. But I think that right now we're in a situation with the markets that it's anyone's game. I would not be surprised at all to see this dip get bought up and for us to roar back to all-time highs and squeeze all the shorts. Everybody thinks we're going lower. Everybody's bearish. I would not be surprised to see that. I also would not be surprised at all to see it roll over.
So you don't really have strong conviction
I don't,
in either direction right now?
You can't have strong conviction here, in my opinion, because all we've done is we have had a big bounce as of, the last few weeks. That was a pretty significant bounce.
For sure.
Right? Like, and it was not only significant, it was strong.
Yeah, it was over 10% from the March lows.
And so we're pulling back from that, which technically is exactly what we should be doing. We're 20, 30% retracement from here, from that low. So until we see a deeper retracement, I want to see a deeper retracement to get more bearish.
Mm-hmm.
To me, it's just anyone's game in terms of price action.
Yeah. Travis, do you have an opinion or a strong conviction?
Yeah, I mean, thinking about the fundamentals, I think corporate earnings growth has peaked. We've seen some charts kind of indicating that already. But I think especially as we move into the back half of the year, just because of the inflationary pressures, I think we will see that corporate margins have peaked, corporate profitability, and therefore earnings growth is probably peaked in this current cycle. So I expect the market to potentially reprice the indices overall based on that. I think basically, long story short, I think there's probably about 20% downside in the S&P if, fundamentals take over. Now, fundamentals don't always take over. So
fundamentals don't matter. What are you talking about?
But what I base that on is basically looking at, earnings estimates overall for the S&P 500 index companies, and looking also at the price to earnings multiples that I think we could compress to based on interest rates rising. So like many, asset classes, stocks very much depend on what the overall prevailing interest rates are. And we've already seen interest rates rise, and therefore, stocks, I think, should see some compression in the earnings multiples. And if earnings themselves are not growing or even potentially shrinking by the end of this year, then you have both compression in the multiple and, potentially pressure on the earnings themselves. And that's why I think we've got, if I just kind of do the back of the envelope math, probably about 20% downside from here based on just kind of my fundamental outlook for this cycle where we're headed with interest rates and corporate earnings.
So Trav, where does the real rates story fit into this for you? Because in my personal opinion, I'm looking at things that I could be putting capital into, and it's like, there's really nowhere to go but equities. So does the real rate story, meaning inflation being higher than yields, kind of help cushion that blow a little bit?
Yeah, it's a great point. No, I definitely think it could, with bond yields still, even with rising yields, they're still earning well below, current rates of inflation. So I think, stocks could be maybe a place for some people to hide, to try to earn a higher nominal yield and therefore a slightly higher real yield. But I think stocks are going to have to reprice downward at some point to be able to give investors a positive real yield going forward. Therefore, I think you've got to have a correction so that the forward returns improve, because otherwise the forward returns for stocks, especially if corporate earnings aren't growing, don't really look that great. So that's my concern, is I think you need a repricing first for then people to realize, oh, stocks actually are providing probably one of the best real returns going forward. But I think you have to have a repricing downward first for that to happen.
Right.
Maybe it doesn't happen. Maybe, like you said, maybe, rates, maybe if the Fed moves slower than market participants expect, then, bond yields stay so deeply negative from a real return perspective that you almost have to invest in stocks or crypto or even real estate potentially to earn a better real return. That is possible. I definitely see that possibility.
Right.
But
so how about this? How about if the market recovers from here, people buy the dip, and we see an all-time high breakout, we all throw away all of our finance books. We just throw them all out the door, because what does it even matter anymore? Nothing makes sense.
It's good to ask that question though. What is the scenario where, we end up at 5K or higher on the S&P by the end of the year? What would be the driver of that? I think that's actually a really important question to ask. If I think through that a little bit, I think it's partly what you said before. Like if we actually do see corporate earnings be relatively resilient, then stocks as a whole on average, right? Not every stock, but stocks as a whole could actually be providing a better real return than a lot of, bonds or other assets. And so that could be one reason. A second reason could be maybe people see far enough ahead that some of the structural inflationary problems start to recede. Like you mentioned the whole goods sector, right? The goods sector is where we saw a lot of really significant inflation start this whole cycle. And we're already seeing some of the trucking indices start to roll over and things like that. We're starting to see that consumer behavior change where they're preferencing services and things like that. So maybe that inflationary problem actually does start to potentially weaken, or at least we have line of sight to see that weakening in 2023. And then the markets do look ahead. So if the markets can see a credible path to getting out of the current cycle, then yeah, absolutely, you could rally.
Or if the pricing power is there and they just pass it to the consumer, and then consumers are getting higher wages because the unemployment rate is so low and people need to hire people, so they're paying more, I guess that could be a sequence that could lead you, to the market actually not rolling over too much.
Yeah. Like you said, the consumer being more resilient than expected in the face of inflation, that would be a reason for a lot of people to be optimistic as well. So I think the one thing that still concerns me here out of all of this is the problems in energy and agriculture, because there's really nothing to change consumer sentiment, like seeing much higher prices at the pump, but even more importantly, I think much higher prices at the grocery store. And if you start to see real shortages of critical food products, meat, poultry, et cetera, then that starts to get really scary when you start to have like people wondering if there's going to be enough food for them to buy and at what price at the grocery store. Look, I'm not trying to start a panic, but we've seen some issues with like fertilizer prices going much higher. We started to see, prices in ag become a little bit concerning. We started to see, some call outs of what's happening in areas like poultry and in meat production, where there's some kind of flashing red signals. That's what scares me, because again, that could really affect consumers' mindsets if that becomes a real issue later in the year.
You guys make some great points. And in the back of my mind, I've just been thinking, okay, well, how does Bitcoin fit in or react to each one of those potential outcomes? And it's really hard to know. The one thing that I've been basing my, I guess, lack of analysis on, because there's not really a whole lot to try to guess here, because unfortunately this year, Bitcoin's been very, very correlated to stocks. Trav, I think it was last time we were in Bali, which was late 2019, right before COVID. You ran the data and we saw evidence that Bitcoin was uncorrelated to the S&P 500. But this year, if you just look at the year-to-date charts, I mean, they've been pretty much directly correlated. So I'm like, all right, well, I'm letting that be my guide then until something else presents itself to be true, right? And if we look at the past full year or more in Bitcoin, we've had over a dozen tests of the 45K, what I call the magnet price, right? So I don't know. I mean, I know the long-term narrative for Bitcoin is intact. And obviously when we talk about inflation and money printing, right, they're on a long time horizon, obviously Bitcoin has performed exceptionally well. The one thing that we're yet to see is, how does Bitcoin do during a real recession, right? Because it was born literally like the bottom of the stock market in 2009. So, we're that's yet to be seen. It could sell off with stocks. If it does, that's fine. Bitcoin's no stranger to deep 80% or more drawdowns. Or does it kick the trend and decorrelate and say, okay, people are jumping out of stocks and they're going to Bitcoin as a store of wealth and a flight to safety? I don't know. I guess that's the $200 trillion question that we just got to be patient and wait and look for.
Well, it is a risk asset. And during recessions, people usually are fleeing risk assets to go to safer assets, right? Bonds, whatever, cash,
I guess unless rate, unless inflation stays high and people don't want to just hold a bunch of dollars.
That's going to be interesting to see, because I personally have thought that Bitcoin's price action, when you compare it to the NASDAQ and S&P, I feel like Bitcoin's price action in that, segment of time has been stronger. Sorry, that was my trading part. The market just closed. So I feel like when you look at the actual price action, we've seen higher lows on Bitcoin. And I think that Bitcoin has shown a stronger price resilience than the indices, in my opinion.
A little bit, but it's still dead flat.
It's still definitely
it's tracking,
correlating and tracking.
Anytime there's been a sell-off in stocks, Bitcoin sells off right with it. So that there is that emotional kind of knee-jerk reaction that we need to get away from for Bitcoin to really take on a life of its own and to grow independent of what stocks are doing.
I think that's going to be a tough one.
Me too. I mean, I'm waiting for it, right? I'm a long-term Bitcoin bull. I'm one of the earliest investors. Like, I believe in it, but I'm also not a blind bull where I ignore that it's when stocks panic, it goes with it, right? If you're just smoking hopium and you just think it's going to go up no matter what, like, you're going to get hurt. You need to look at reasons why Bitcoin could sell off and what would cause that and how you would respond to that. If anything, maybe your thing is, I just hodl and I dollar cost average and that's it. If so, cool. If you're more tactical and you want to get a better cost basis or, try to position size better, that's where that becomes more important.
I personally think it could be a pretty good buying opportunity if we see the crypto complex sell off with, if we do get a deeper stock sell off, because Bitcoin particularly, I would expect over an inflationary cycle to outperform maybe some of the more speculative parts of the crypto ecosystem. Now, like you said, I think, immediately upon a deep sell-off, I think, as a risk asset probably could take a hit in the short run. But, I think the deepest washout I would expect would come in areas that have been very, very hot and frothy, like NFTs. And then I would expect Bitcoin maybe a little bit further into that sell-off and further into the inflation cycle, that it could actually start to outperform and start to go up again, just based on the fact that, hey, it is a relatively constrained supply asset at a time when you don't have a whole lot of other assets, maybe outside of commodities that have that property. And so that would be, I think, again, a potential buying opportunity if Bitcoin particularly did sell off deeply alongside the crypto complex with stocks as well. So that's kind of what I would be looking for personally.
Yeah. I mean, look, if we were blessed with another 80% or more drawdown from all-time highs, I would be elated. A lot of people would be depressed, but that's when I get really excited and I did several videos on this talking about why the best time to buy Bitcoin is during those. So if we do get a sell-off from here and we get cut in half, great, I'm going to buy more. If we maintain this higher range and we break out above it, great, I'm going to trade that as well. So there's plays to be had no matter what happens. It's just playing out that, right? Like the mental side of, okay, what's everything that could happen? And like, how would I respond in any one of those scenarios? That way I'm not surprised and I can actually capitalize no matter what Bitcoin in the stock market does. Right. And I think that's a good question that you get a lot, right? Is like, hey, how do I, or should I invest in the stock market now, or should I wait for a recession? Seems to be a common theme right now. Is like, if people are thinking a recession is coming, do I wait or do I buy now? I mean, that's a great question for Bitcoin too, but I think in stocks, people are always thinking about that, trying to front run the potential for a recession. What do you typically say when you get that?
This is a big question I'm getting right now because it's retirement contribution season. So a lot of people have lump sums to put into, different types of accounts. And I always, tell people, obviously you have to think about your time frame. If you have a lot of time ahead of you to have your money invested, this could end up looking like a blip on the radar, in a couple of decades. And does it really matter? And the data shows that if you get a lump sum in now, it's going to perform better likely than trying to time the market, because many people are just very bad at timing the market.
True.
But look, the way I'm doing it right now, I'm actually going through this exact process with, contributions, and I have decided to dollar cost average. So literally I'm putting in a few different chunks along the way, and I'm giving myself some time before my next few chunks. And if the market looks like it's going to rip higher, obviously I'm looking at the technicals and I'm paying close attention to this, but if the market looks like it's going to rip higher, then I may have to just go in and, oh, well, if I miss the recession, if I miss the dip, oh, well, but because you just don't know what's going to happen. And you don't want to be in a situation where the unexpected does happen and you're not in. And that's how, you lose your return over time, by trying to time it and messing up. So I think it's important to just think through your time frame. If you have a long time to be invested, don't stress it. You can dollar cost average if you're that worried about it, and just pick, a 6-month period or whatever it is, and put in chunks of money along the way. And that'll give you the opportunity. If the market does go down, great, you have some cash to throw. If it doesn't, you're sticking to your plan and you're getting in eventually. And that's kind of the best way to do it.
And I think maybe it's important to point out that there's a big difference between like passive longer term investing and tactical short term trading, right? Those are two very different things. And whenever you typically get that question, it's people thinking about their retirement accounts and, hey, I don't know anything about the stock market, versus like.
Well, also, I am getting that from the community too. People that are active investors and they have capital that they're deploying, and they're a little unsure what to do with it. Mm-hmm. So I think it goes on both ends. And I think if you're active, it completely depends on the market environment. Like right now is a great time to have cash, right? If you're active, because so many stocks have been beaten to crap and there's opportunities out there. But if you're passive, don't overthink it. Just get invested, and your dividends will reinvest when the recession comes, When those dividends come, they'll help you out later, but don't stress it too much if you're passive in long term.
So, Trevor, are you YOLOing everything in, or are you net short? Are you flat? What's your bias right now?
My net exposure isn't too high because I have about half of my portfolio value hedged not perfectly hedged, but I do have about half of the notional value of my portfolio in short futures and short index hedges. So
that's pretty heavy, right?
Yeah, that's pretty heavy. And yeah, that helps me, to be able to sleep a little better in terms of the overall, macro environment, and deploy capital as I see fit. But yeah, I mean, I think, Nikki mentioned, it's really hard to time macro environments perfectly. And particularly towards like the end of when the cycle turns, like markets are always going to bottom well before all the bad news is over. So markets are very forward looking. And I think this could be one of those situations where if we do go into recession, if we do see stock markets pull back, it could be relatively short lived. And a lot of people who try to get out of the market may miss that window where they do miss the bottom, and they maybe stay out for a long time. I saw that happen to a lot of people after the great financial crisis. People stayed out for years and missed like really, really good opportunities. The other thing I would say, and I think I've said it before, but even in grinding bear markets, there are hundreds, if not thousands of stocks that will still have positive performances. So that's another thing to think about, is like, there's still going to be fertile hunting grounds within asset classes like stocks or crypto, even in bear markets. So it's important to remember that too. There are also other ways to tackle this. Like if you're really fearful about putting in capital during, times of market turbulence, well, maybe look at, could you allocate more capital towards a value-based index where the market multiples are lower and the dividend yields are higher, or maybe like a buy right index where they're earning income every month by, writing call options against it or something like that. So there are other options, for trying to kind of almost hedge yourself a little bit in a retirement aspect, I guess, when you're trying to think about, well, I'm fearful of the macro and I want to try to reduce the risk that I pay too high at prices. So those are some things to think about, or, like I'm doing, maybe take on some index hedges. And, of course, the risk there is that the market does rip higher and the index hedges cost you some percentage points of performance. But that's just something you have to be okay with if you're going to do that.
Yeah. It's interesting. There's different ways to play the futures markets, right? Like you've got a direct short hedge on your portfolio. I'm like, all right, well, I guess another way to do that is kind of what I'm doing with the managed futures. I don't know if I'm long or short. I'm letting the algo guys dictate that. And as long as there's big volatility and trends, like I think on the ag side, agricultural and commodities, like they've done particularly well because the volatility has been so high. And in the event of a stock market dropping 20 to 50%, I think those same strategies would also do really well. So it's kind of funny because I'm technically trading the futures markets blind. I don't know if I'm net short. I'm just assuming that because of the way those algos work, that in the event of a market crash, they're going to do well. So I don't know. It's weird for me because I used to be an active trader and I used to hedge and actively day trade the E-mini futures. But ever since I relinquished that control, it's kind of been nice, but it is weird because I just don't know what positions I'm long or short on any given day. I just trust the process.
They're probably long.
Well, they'll flip. I mean, most of the strategies that I've decided to invest in is trend trading. So
yeah, well, I don't know. I mean, if the managed futures portfolio is up 35%, I would think they would be net long. But
yeah. I mean, they catch rips, right?
Yeah.
They catch the big moves. So,
but yeah, you're right. It's like, you're like, I don't know.
I don't know. The caveat on the downside is like a lot of those funds to get in, like some of the top performing ones, you need $1 million minimum. But a lot of high quality ones too, you can get in with 100K, but you do have to be accredited a lot of times, which, oh my God, I'm not going to get on that tangent again, but I think that's just bullshit that so many people are left out of that, startup investing, a lot of managed funds. Like
they tried to change it and they changed it a little bit,
but it's not good enough.
It's not good enough still.
We're still miles away from where it needs to be.
For sure.
Anyway, I guess we can leave it on that. Any other things, topics, questions?
Oh, you didn't want to talk about Cathie Wood thinking oil's going to get to $12 a barrel?
I accidentally clicked X on the tweet. What was it? Cathie thinks oil's going away.
Yeah, I guess there was a tweet that was going around and she basically, it's like, because of electric cars, I think oil in time, could get to $12 a barrel.
Well, it was just there.
Twitter found it hilarious.
Yeah. I mean, what was this? So this is showing where energy gets consumed or where oil goes.
Yeah. I think that the narrative with her is that electric vehicles, or at least this is what it feels like, electric vehicles are going to save the day. And like transportation is only a portion of what
quarter.
energy is used for. And, I don't know. It was hilarious.
Okay. So oil's not going anywhere then.
I don't with oil where it is and with the energy crisis, and us trying to figure all of this out now, it's just kind of a funny thought that she would say that based on electric vehicles kind of taking over. And I think we have a long way to go.
Yeah.
I am looking forward to the day when Cathie Wood is no longer in our financial headlines, because I think she's already blown her credibility. And I think there are more visionaries out there that actually have a clue. So I'm hoping that we hear less about Cathie Wood over time. But...
So you don't think that oil's going to $12 a barrel in the future?
I mean, I highly doubt that, but
it doesn't feel very plausible, but I guess
but guys, I need to point out that it was just there.
Wait, show me.
Yeah. I mean, it technically went negative, but
but it went negative.
And that was only on the front month contract.
Yeah,
and we also shut the world down.
Wait, where'd my oil chart go?
It's the first one.
Okay. Oh yeah, there we go.
There it is.
All right. So yeah, if we look at oil, For anybody that doesn't know, back in the COVID
Come on,
panic,
that's what you're going to count.
no. Listen, it went negative, but you can see if we go to a daily chart, it traded around the $10 to $15 mark for a few days. Like you could actually get fills down here.
That was an anomaly.
Yeah, I know. So look, 10 to 15 bucks you could have bought in there. You couldn't have bought obviously on the negative prices, but you could have bought around 10 or 15. So I don't know. I'm just pointing this out because I know really nothing about the energy markets. I'm not going to pretend to be an expert there, but look, it was just there 2 years ago.
I've been trying to understand the energy markets a lot better. I've been spending time to try, and it's actually quite fascinating when you start to uncover it, and all of the people that are predicting that oil could actually go higher as renewables come online and as electric vehicles come online and as emerging markets are using more oil as they, progress in their economies. I don't know. It's just interesting. And
that is an interesting counter trade thought. Like
what if demand actually goes up?
Yeah.
I don't know.
I have nothing else to say about that. Trav, what about you? Any final thoughts?
Well, we're going to have to cover the diesel shortage in the next show, but that's something for another time. But that's something concerning on the horizon that you'll be hearing more about.
You're such a Debbie Downer, Trav.
Wait, we got to keep it real for the listeners and the viewers, man, because I don't know. It is a weird time seeing prices fly sky high in the grocery stores and at the pump and stuff. I mean, your average person is definitely feeling the squeeze.
Absolutely. Yeah. This hurts the lower income individuals, unfortunately. And that's what sucks.
Yeah. They get hit first.
Mm-hmm.
So, all right. Well, guys, hope you enjoyed the show. Thanks for tuning in, and it's good to be back. Well, I feel like I've said like new studio like 5 times in the past year, but this is part of the process of like buying new places and traveling. And we're going to be back on the road here in the summer. Got some exciting videos planned for you guys.
Oh, yes. Yeah. So thanks for bearing with us through all of our background changes and our terrible Zoom connections that we had at times.
Yes. Papa Elon delivered Starlink to the ranch, and we've got new office space, and it doesn't matter where we go. Now we're going to have a studio. So it's good.
Well,
good to know.
Got to stay with it.
Yeah. All right, guys, go to wetalkmoney.com, submit a question for the show. Check out the wealth building community. You can go to wetalkmoney.com/community. Thanks to Y Charts for sponsoring the show. Thanks to Travis and Nikki for joining me on this. And we will see you guys next time.
See ya.
Take care.
See ya.